This is Nightly Business Report with Sue Herrera and Bill Griffin.
Stocks plunge. China strikes back with retaliatory tariffs, wiping out about $1 trillion in market value worldwide.
Caught in the middle, a small New Jersey manufacturer is pulling back on growth plans as it tallies the cost of tariffs on its business.
Price-fixing accusations. A sweeping lawsuit claims generic drug companies conspire to inflate prices, and their stocks fall sharply. Those stories and much more tonight on Nightly Business Report for Monday, May the 13th.
Good evening, everyone, and welcome. What a way to start the week. Stocks fell sharply at the open and stayed there as tensions flared when China slapped new tariffs on U.S. goods. The fear is that a heightened and prolonged trade fight between the world's two largest economies could hurt global growth and have a very broad impact. So let's get right to the closing numbers. The Dow Jones Industrial Average dropped 617 points to 25,324. The Nasdaq was lower by 269 points, and the S&P 500 fell 69. Kayla Tausche starts us off tonight with the latest developments on the U.S.-China trade war.
Both the U.S. and China are arming themselves with new weapons as the trade war drags on. China says it will slap new tariffs on $60 billion in U.S. goods, from light bulbs to peanuts to beef, as the U.S. targets the remaining $300 billion in goods China sends to the U.S. each year that have so far been spared. President Trump says he hasn't decided yet whether to launch those tariffs.
We have another $325 billion that we can do if we decide to do it.
As tensions heat up, there's room for some goodwill. China's new tariffs don't take effect for 3 weeks, and President Trump is now pointing to the G20 meeting at the end of June in Japan, where he'll meet China's President Xi.
Maybe something will happen. We're going to be meeting, as you know, at the G20 in Japan, and that'll be, I think, probably a very fruitful meeting.
The next several weeks will be critical, with the Treasury Secretary saying he plans to keep talks open.
When will you go to Beijing?
Working on dates, nothing confirmed yet.
China may be sharpening other tools, too. State paper The Global Times says it could stop purchasing farm and energy products, cut back on orders of Boeing planes, and possibly dump treasuries. Mnuchin dismissed that idea.
China continue to buy our debt?
I assume so. It's a great investment.
Despite the volatile market reaction to the recent tit-for-tat, President Trump says he loves the position the U.S. and its economy are in, and negotiators continue to say he'll walk away if any deal doesn't produce permanent change. For Nightly Business Report, I'm Kayla Tausche in Washington.
And as Sue mentioned, the trade tensions resulted in some very strong selling on Wall Street today. Bob Pisani takes a look at the market's ugly mood.
Trade tensions flared up today, putting serious pressure on stocks. The Dow plummeting more than 700 points at its low, but closing well off of that. Stocks were down overnight, but they turned even lower prior to the open when China announced it will raise tariffs on $60 billion of U.S. imports beginning June 1st. These new higher tariffs will largely hit farmers and affect thousands of products. Apple, Boeing, Caterpillar led the Dow lower here. All three are down about 20% or more from their recent highs. Stocks did come off of their lows late in the day on a few comments from both U.S. Treasury Secretary Steve Mnuchin and President Donald Trump, saying trade talks were still ongoing, but that's still too much for the markets to go on. Why is this? Because the trade wars have suddenly become very real. We not only have higher tariffs on existing goods, we have a very specific China response targeting U.S. agricultural products with possible other measures to come. That's taking a toll on commodity prices. So, for example, soybean futures, they plummeted to their lowest levels in more than a decade, and cotton prices are also coming under pressure. And we've had talk of the U.S. expanding tariffs to all China imports, which would particularly target the technology field. One reason Apple's down 5% today. But for many, the damage is already done. Retailers are getting hit because their input costs are about to rise. So names like Macy's, Gap, Nordstrom, L Brands, they all closed at new 52-week lows today. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
More now on Boeing and the bond market, both of which Kayla mentioned in her report. The editor of the Chinese newspaper The Global Times tweeted, China may stop purchasing U.S. agricultural products and energy, reduce Boeing orders, and restrict U.S. service trade with China. Many Chinese scholars are discussing the possibility of dumping U.S. treasuries and how to do it specifically. A Boeing spokesperson says that the company is confident the U.S. and China will continue trade discussions and come to an agreement that benefits both U.S. and Chinese manufacturers and consumers. Nonetheless, the stock fell more than 4.5%.
And what about that line in the Chinese editor's tweet about China selling U.S. treasuries? Now, China is the biggest buyer of our debt. What would happen to interest rates and our economy if it started selling those treasuries? Joining us tonight, Bill Adams is senior economist with PNC Financial Services Group. Bill, thanks for joining us tonight.
Thanks for having me, Bill.
It is considered highly unlikely that they would think about selling too many of their treasuries. But what do you think? And isn't it interesting they even brought it up in this tweet? What do you think would happen if they did start thinking about selling in size?
I think if we did see a large sale of treasuries by China's central bank, we would see treasury bonds fall. We would see yields move higher over a short period of time. But I think after that, it's likely that the Federal Reserve would intervene in the treasury market and buy treasuries. That's what the whole point of quantitative easing was. And if they saw treasury yields moving in a direction that was out of line with their goals for the U.S. economy, then I think the Fed has the tools to bring interest rates back where they want them.
Art Cashin, down on the floor of the New York Stock Exchange with UBS, suggested that perhaps a worst-case scenario would be if China just stayed out of the auctions and didn't buy any more U.S. treasuries. What do you make of that scenario?
I think China has already stepped back quite a bit from financing the U.S. government. Chinese foreign exchange reserves peaked at around $4 trillion U.S. dollars a few years ago, and now they're down to around $3 trillion U.S. dollars. So China has already changed from being a net buyer to a net seller over a multi-year time horizon. And the 10-year government bond yield is only 2.4% right now, and the U.S. economy continues to grow.
But again, we don't want to panic anybody. It's highly unlikely that the Chinese would sell too many of their treasuries. Why is that? Let's explain that.
Well, China owns treasuries not because they like the U.S. government or they want to finance it, but because it's an insurance policy against a shock to the Chinese financial system. Treasuries are a risk-free asset in the United States, and the U.S. dollar is the world's reserve currency. So having treasuries is a buffer against bad things happening outside of China and infecting the Chinese financial system. With this conflict between the United States and China and downside risk to global growth, all the more reason that China doesn't want to tear up its insurance policy today.
Bill Adams with PNC Financial Services Group. Again, thanks for joining us tonight, Bill.
Thanks for having me.
The tariffs already in place have not been kind to a manufacturer in New Jersey. Contessa Brewer took a trip to Piscataway to measure the impact on the business firsthand.
A long line of products facing a long list of tariffs. Strato designs and manufactures equipment for the railroad and transportation industry, but the tariffs are derailing plans for growth. Many of the finished parts are made in China and sent to the U.S. They were just slapped with a tariff increase, now totaling 25%. It will cost this small company in central New Jersey $14 million over 15 months. And buying all-American isn't an option.
The problem is the industry is only supplying about 30% of the products necessary for the industry domestically.
These parts will equip San Francisco's public transit system, known as BART. It will pick up the additional cost of the tariffs, which means taxpayers and riders are footing the bill. Strato is hiking prices as much as 10% and passing that along to its railroad customers.
It forces the railroads to do is pass the costs on to the shippers. The shippers have to pass the cost on to the consumer, and that's every one of us.
Like thousands of other American businesses, Strato is searching for ways to cut costs as it absorbs the rest of the tariff impact. Its workforce has declined 10%. And employees here are worried because their bonuses depend on the company's growth. And Strato has significantly slowed its expansion.
We've invested about $30 million in the last 5 years in new product development. We are pulling that way back at this point in time. And it's slowing the development for the industry. The economy is going in the right direction. It's growing. The rail system needs to grow with it.
Those stuck in the middle of a global trade war are just hoping that something will spark a change. In Piscataway, New Jersey, Contessa Brewer, Nightly Business Report.
As you can imagine, the Federal Reserve is watching how this tariff spat plays out and how it may affect the economy. And right now, market expectations for a rate cut are changing. Steve Leisman has more.
In the wake of new tariffs from President Trump's on Chinese goods and Chinese retaliation on U.S. goods, markets are now pricing in a quarter-point cut from the Federal Reserve by October and maybe as soon as September. The probabilities in the Fed fund markets now price a 50% chance of a cut by September, 60% by October, 75% by December, and 90% by January 2020. But for one Fed official, it's too soon to make that call.
I'm hopeful that cooler heads will prevail and this won't go down a very nasty path. Obviously, if it's the worst case scenario and it's ever increasing tariffs for an extended period of time, that could change things. That could have a real effect on U.S. GDP growth. But right now, I'm not seeing it. And so I'm in a wait and see mode.
Gauging the economic impacts of tariffs is hard enough. The Federal Reserve also has to weigh the probabilities on the outcome of negotiations, whether or not there's a deal, how long tariffs could be in place, how equity markets respond, and the economic impact of lower stock prices, and the effect of all this on business confidence and capital spending. J.P. Morgan in a report writes that the trade war could hold global capital spending growth to zero this year and dampen Chinese GDP by 0.8%. The escalation of the conflict could also amplify an easing bias, that is, rate cuts across the globe. All of this leads Morgan Stanley to forecast serious easing by the Federal Reserve of interest rates. If the trade battle lasts 3 to 4 months, Morgan economists see more Chinese stimulus and 50 basis points or a half a percentage points of cuts from the Fed. For Nightly Business Report, I'm Steve Leisman.
So with Fed expectations changing and the market selling off, is now the time to get defensive? Joining us is Jack Ablin, founder, partner, and chief investment officer at Crescent Capital. Welcome back, Jack. Nice to see you.
Nice to see you, Sue.
There are some expectations that this will be a long fight, and others say maybe a little bit on the shorter side. You say stay put for now as an individual investor. Why is that?
Yeah, I'm not ready to pull my hair out quite yet, Sue. I think that there are really 3 stages of downdrafts. There's a technical one, which we're currently in. Then there's one, what I would call cyclical, which it starts impairing the global economy. And then there's systemic, one that we had to endure back in the financial crisis. The good news here is we can take systemic downturn off the table. So now the question is, are we in a technical downdraft, which perhaps there's a 10% downside risk to, or something more cyclical where now these tariffs start to impact economic growth globally and that the downdraft could be a little more severe. There's no evidence yet that this war is going to just continue on to start impairing economic growth.
Right.
And so from my perspective, I'd say we're still in that technical phase, and it's probably worth just standing pat for now.
So you'd stand pat, but would you buy with some of the declines we've seen in the last 2 weeks?
Yeah, I mean, I think, for those investors who have dry powder sitting on the sidelines, certainly a couple of, easier ways to get into the market would be those parts of the market that are somewhat insulated from the vagaries of these kinds of, tariffs, and that would be U.S. small caps. They would tend to do better as this tariff talk escalates, because they tend to do most of their business here domestically. Certainly a focus more on services rather than goods could also be another way to play it. Another would be REITs. REITs are generally considered U.S. based, pretty much just real estate. Now, they are expensive, but they have done pretty well as a defensive play in this kind of environment. And then lastly, master limited partnerships, MLPs. Again, domestically focused, income oriented, and they are cheap, but keep in mind they are tethered to the global, crude market. And so if we do see a sell-off in crude, they'll likely go along with it. But again, they're cheap enough that there's a cushion there and a decent yield.
Jack, thank you so much. Jack Ablin with Crescent Capital. Still ahead, 44 states, a handful of drug companies, and one sweeping lawsuit.
Back to Boeing. That company's not only dealing with China right now, but also the fallout from those two deadly 737 MAX crashes. One of the planes that went down belonged to Ethiopian Airlines. And tonight, in an NBC News exclusive, the CEO of that airline said that he's not sure what the future holds for his company and for the airplane maker.
I cannot fully say that the airplane will fly back on Ethiopian Airlines. It may, if we are fully convinced and if we are able to convince our pilots, if we are able to convince our traveling public, because, you know, all other airlines have grounded the airplane. But in our case, beyond grounding the airplane, we had this tragic accident just a couple of months ago. So it takes a lot of efforts to convince everybody that the airplane is safe. But beyond that, I think we have to convince ourselves. And we want to do that.
He added that if his airline does fly those jets again, they'll be the last to do so.
Apple, already under pressure from the trade war with China, got more bad news today. The Supreme Court will allow an antitrust class action lawsuit to move forward after a group of iPhone owners accused Apple's App Store of being a monopoly. The opinion says consumers have the right to sue the company. It does not accuse Apple of violating the law. The stock fell nearly 6% in today's session.
And it was a tough day in the marketplace for some drug makers. 44 states have now filed a massive lawsuit accusing a number of pharmaceutical companies of conspiring to inflate generic drug prices. Teva was hit the hardest among that group, down almost 15% today. Mylan and Pfizer were also named in that lawsuit. Meg Terrell has the details.
The generic drug industry exists to make medicines less expensive. After patent protection expires on branded drugs, generic drug makers compete to bring cheaper copies to market. At least, that's how it's supposed to work. A new lawsuit from more than 40 states alleges generic drug makers instead conspired to drive prices up, sometimes by as much as 1,000%. Connecticut Attorney General William Tong detailed the allegations in an interview with 60 Minutes.
I think what we've come upon is that the generic drug industry is the largest private sector corporate cartel in history.
The news drove stocks of generic drug makers down sharply Monday. The suit is a broader version of one filed in 2016 involving 15 generic drugs. It alleges that 20 generic drug manufacturers, including Teva, Mylan, Novartis' Sandoz, a Pfizer unit, and others, quote, embarked on one of the most egregious and damaging price-fixing conspiracies in the history of the United States. The number of drugs, more than 100. The cost to consumers, the lawsuit claims, billions of dollars.
It's devastating. It affects health insurance premiums and health insurance plans. It impacts Medicare and Medicaid, and it is a chain reaction that drives up the price of American healthcare to unnatural heights.
The drug companies deny the allegations, and the generic drug trade group, the Association for Accessible Medicines, further points out that generic drug prices have declined over the last 3 years. The lawsuit mainly focuses on activity from 2013 to 2015, but it's clearly spooked Wall Street.
Depending on what it could be, this could be problematic or really problematic.
The lawsuit seeks damages, civil penalties, and return of profits from the alleged price fixing. And the states say the investigation is ongoing. For Nightly Business Report, I'm Meg Terrell.
Tariffs are another thing that Ford and GM have to worry about in China, and that's where we begin tonight's Market Focus. Auto sales in China fell for the 10th straight month in April, falling nearly 15% from the same month a year ago. Ford's China car sales fell 37% last year, while GM slipped 10%. Today, GM fell 3.5% to $36.56. Ford was off 3% to $10.08. The CEO of Bed Bath & Beyond is stepping down from the company, effective immediately. This comes as activist investors are pushing for changes at the retailer after sluggish sales. The CEO is also resigning from the board. Shares of Bed Bath were down more than 4% to $15.08.
Nielsen is reportedly pulling out all the stops to try and keep its last remaining bidder, Advent International, at the bargaining table by lowering its asking price. The New York Post says that the offer could be as much as $20 billion, and the ratings company agreed to push back the deadline to June after Advent needed more time to conduct its due diligence on this. Nielsen shares fell about 3.5% today to $23.75. And following a disappointing debut on Friday, Uber shares continue to decline today. Some investors are questioning if the ride-sharing company may take the same path as rival Lyft, whose shares are down by nearly a third since it came public a few months ago. Today, Uber shed nearly 11% to $37.10.
It is Infrastructure Week. Events are being held across the country with a focus on rebuilding and modernizing portions of America's infrastructure. Tonight, we take a look at the drive to be less reliant on the electrical grid. Home builders are leading the charge, using the latest technology to build large developments that use no energy at all. Diana Olick is in Irvine, California.
From the outside, these look like your basic California condos, 44 units. But inside, they're actually zero, net zero, meaning they produce as much energy as they use.
The multifamily is more challenging because you don't have as much space for solar collectors. It's a tighter site. The land is more constrained, so it's a lot more complicated to execute.
Meritage is the first large-scale production builder to move into multifamily net zero with this complex in Irvine. It's all electric, using energy-efficient lighting, appliances, and HVAC, and heat pump water heaters. It's built using spray foam insulation, not just in the attics, but in the walls, making the interior much tighter so heating and cooling are more efficient. On the roof, high-efficiency solar panels. The development is using new rules from the state's Public Utilities Commission that allow output from a community solar system to be distributed to individual homeowners throughout the complex.
Even sunny California isn't sunny every day, so when the sun is shining, the solar systems produce more energy than is needed, and that energy is sold back to the utility company, and the homeowner gets a credit. So on dark, rainy days, they use that credit, and the bill comes out to net zero.
And if you have no utility bills, that's going to allow you to buy more house, and people are excited about that.
High demand for housing like this will in turn reduce the demand on electricity for the nation's electric grid and infrastructure.
So it's not just about distributed solar. It's also about our buildings being able to be grid responsive. So utilizing renewable energy when it's available in our buildings and not utilizing grid energy when it's not very low carbon.
The condos are slightly more expensive up front, but the utility savings pay that back in about 7 years of ownership. The payback to the electrical infrastructure and to the planet is priceless. For Nightly Business Report, I'm Diana Olick in Irvine, California.
And coming up, why global trade tensions are putting the multi-billion-dollar art market to the test.
It is springtime in the art auction market, but this year, rising tensions between the U.S. and China could dampen one of the most lucrative seasons for that industry. Robert Frank explains.
It is the biggest test of the year for the global art market. More than 2,000 pieces totaling between $1.5 and $2 billion set to be auctioned off by Sotheby's, Christie's, and Phillips this week. The big question: will the trade war, market swings, and China slowdown scare away the big bidders? Chinese buyers accounted for 29% of all global auction sales.
Of the top 20 lots sold at Sotheby's last year, 6 went to Asian buyers, so China is critical to the growth of the art market. But all collectors will be keeping a close eye on the stock market as well.
The biggest risk to the art markets is the same risk to the equity markets. It's the same risk to other things. It's black swans, challenges on a macro or political level. But there's not anything more focused on art than anything else for an equity or bondholder.
Many of the top trophies this week came from estate sales. The estate of Cy Newhouse, the former chief of Condé Nast, is selling the most expensive piece, Jeff Koons's rabbit sculpture. It is considered Kunz's masterpiece. He only made 4. This is the last in private hands. It's expected to sell for $50 to $70 million at Christie's, even though it remains highly controversial.
That was such a shocker when Jeff first exhibited in 1986. People were thinking he's out of his mind. People called it outer-worldly, alien, awful, everything. So it was a really radical sculpture.
Christie's also selling this piece by Robert Rauschenberg, titled Buffalo 2. It comes from the estate of Beatrice Meyer, one of the heiresses to the Sara Lee fortune, and it's expected to sell for between $50 and $70 million. And Sotheby's will sell one of Monet's famous grain stack paintings for over $55 million. And if you're in the market for a Kunz animal sculpture but don't have $70 million to spare, you can pick up his elephant at Sotheby's for a mere $2 to $3 million. For Nightly Business Report, I'm Robert Frank at Christie's in Manhattan.
And before we go, a final look at the day on Wall Street. Big sell-off to start the week with the Dow down 617 points. NASDAQ was lower by 269. The S&P down 69 points today.
Quite a day.
Yep.
That does it for Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. We'll see you tomorrow.